Assalamualaikum. My name is Noni Jubatakia binti Yusof. My metric number is 823-82457. Today, I will share the result of my research for the Corporate Disclosure Content Analysis Project under the Integrated Case Study course. My research focused on comparative analysis of the financial performance and risk governance between two leading food manufacturing companies on Bursa Malaysia, namely Apollo Food Holding Berhad and Oriental Food Industry Holding Berhad or OFI for the financial year 2033 to 2035. Both companies operate in the consumer product and service sector, especially under the food and beverage soup sector. Let's move on the first objective, which is to examine the slate of revenue and profitability of both entities. In terms of sales volume, OFI has shown very aggressive and consistent growth, with their sales revenue reaching 457,109,207 ringgit in 2035 compared to Apollo 298,450,182 ringgit. However, in terms of operational efficiency, Apollo have performed exponentially well. Although Apollo's sales volume is smaller than OFI, they managed to record a higher net profit of 40,175,478 ringgit in 2025 compared to OFI 38,884,628 ringgit. This is strongly driven by Apollo consistently high gross profit margin of 27.5%, far ahead of OFI at 20.38%. This proves that Apollo has strong purchasing power in the market. Next, if we look at the aspect of asset management and capital structure, Apollo once again lead in this efficiency. In 2035, Apollo return on asset was 15.71%, while return on equity was 70.41% compared to OFI, which is recorded ROA of 11.31% and ROE of 14.60%. Apollo's ability to generate this high return is very unique because they practice a zero-band debt policy. Apollo debt to equity ratio is only around 0.12 times, which is only envelope normal operating liability. Meanwhile, OFI maintain a stable capital structure with large at a ratio of 0.25 times to finance their operational expenses. In terms of dividend yield, both companies are very quality dividend stock, but in 2035, OFI managed to overtake Apollo's slide with a dividend yield of 5.46% compared to Apollo 5.26%. Now, let's move on to the main focus on this study, which is the quality of risk management disclosure, which I present in the form of comparative table with a scoring scale of 1 to 5. First, from the strategic risk aspect, Apollo recorded a low score between 2 to 3 due to minimalist disclosure and only focusing defenses on local competition and the low sugar net trend. In contrast, OFI receives a higher score of 4.67 for presenting a comprehensive analysis of global geopolitical risk, traffic, and international trade restriction. Second, for operational risk, Apollo remained with a score of 2 to 3 with basic information on commodity price, fluctuation of wheat, sugar, and cocoa, while OFI receives a score of 4.67 because their disclosure is very detailed, covering aspects of laboratory quality control through HACCP and ISO 22000 certification, as well as the risk of technical description of factory automation and labor shortage issue. Third, in terms of financial risk, Apollo scored 2 to 3 because their risk is very limited to daily liquidity due to a zero-band debt policy. OFI managed to get a perfect score of 5 because they provide a very in-depth sensitive analysis to manage foreign exchange risk due to large export volume in USD currency. 4. Regarding risk mitigation strategy, Apollo scored 2 to 3 with conservative methods such as monitoring daily price and maintain high cash reserve. OFI record a score of 4.67 actions such as heading through forex, derivative instrument, and robotic machine investment. Finally, enterprise risk management framework, Apollo scored 2 to 3 because of its structure that is centralized under the board of directors without a special risk unit, making their disclosure static and repeated every year. Meanwhile, OFI receives an excellent score of between 4.67 to 5 because it has a mature framework aligned with the international standard ISO 3100-218 under the supervision of the RSMT team. Now, let's move on to the discussion and key insight section to see what the main conclusion and implication of the risk management score comparison are. The first insight is on the transparency gap. This is a very significant philosophia difference between the two companies. OFI practice very proactive and progressive disclose. They do not hesitate to disclose how they manage foreign exchange, volatility, risk, and their international supply chains. In contrast, Apollo opts for a defensive and conservative approach where their annual report only contains basic information that repeat or boilerplate from year to year without a daily current strategy. The second insight involves framework maturity. OFI is clearly ahead in terms of risk governance as they have aligned their system with the global standard ISO 3100-2018 under the supervision of a special committee of RSMT. The presence of this major framework proves that risk management of OFI is dynamic. Meanwhile, at Apollo, the absence of a dedicated risk unit and complete reliance of the board of directors limit their ability to assess risk more comprehensively. Finally, market implication. For an accounting and financial perspective, OFI transparency is critical in risk to information asymmetry in the market. When a company provides clear and independent risk, it discloses its high confidence among external investors and analysts because they can make more accurate risk assessment. For Apollo, to write a report may raise question or speculation about the company through preparedness in facing global economic challenge. To conclude my presentation today, let's look at the conclusion and recommendation resulting for this analysis. For the conclusion section, overall, this analysis clearly shows that OFI has a great advantage in terms of transparency and risk governance. Their framework based on the ISO 3100-2018 standard proves that company readiness to face global market risk in a very dynamic way. For Apollo Food Holding, although their financial position is very stable and secure due to their zero debt policy, their overall conservative and minimalist risk reporting approach limit the information received by the market. This creates a significant information asymmetry gap between these two companies in the eyes of investors. Next, for the recommendation section, to enable Apollo to increase their corporate value and transparency, I propose two main steps. First, Apollo needs to establish a special and dedicated risk management unit or committee so that risk assessment is no longer centralized under the board of directors alone. Secondly, Apollo is advised to adopt align their reporting with the international standard ISO 3100-2018. This is to ensure that their risk reporting is more data driven and no longer just repetitive static reporting. Meanwhile, for OFI, my suggestion is to maintain and strengthen existing mitigation strategy, especially in terms of forex hedging using derivative structure to ensure that their global supply chain and export profit continue to be protected from global economic uncertainties. That's all my presentation. Thank you.